5 stock market myths. What is going on, guys? Welcome into today's video, and that's what we're going to be talking about here today. I decided to come up with 5 stock market myths, mainly to provide some value to new investors watching this video, because I think a lot of these myths we're going to talk about in this video, they're things people just believe. I don't know why they believe them. I don't know where the ideas came from, and they're things that I really believed too growing up, and before I started to get into the stock market, started to research markets and really develop my own opinions about how the stock market can really just give you exponential wealth. So I really hope these myths are kind of like debunked and you really see them as what they are, just myths. And maybe if you, after watching this video, you'll be able to push yourself a little bit more to start researching the markets, researching stocks, researching companies, and start to dabble a little bit more into the stock market and really just take control of your financial future. Anyway, guys, if you do get some value out of this, please drop a like on the video. That really does help me out in a massive, massive way, and I really do appreciate it. Also, remember to subscribe to the channel, turn the notification bell on. We got more and more content coming. 2021 is going to be a great year. It's actually the first video of 2021. I didn't even realize that. It's going to be a great, great year, and let's just get to it, guys. Let's run it. The first stock market myth we're going to talk about on this list is that the stock market is the same thing as gambling. This is actually might be the most important one on this list and the most common one on this list. I hear this one all the time. It drives me absolutely nuts, guys, more than you can believe. And we're going to talk about that right here. So people think, you're investing in stocks? Why don't you just go to Foxwoods and play blackjack? Why don't you just go down to Mohegan and play Texas Hold'em? Guys, the stock market is not even close to anything like gambling, okay? Gambling, let me tell you about gambling, right? Gambling, you go to the casino, you put down money to play blackjack. People take money from the winner and they give it to the loser, right? That's gambling. If you're the house, you win, you keep the money. If you're the customer, you're the person gambling, you win, you keep the money. Same thing, vice versa. You lose, you give the money away. That's how gambling works. Investing, you're buying assets. You're buying assets that you believe are going to appreciate over time, that are going to make you more money. Here's another thing. Look at it this way, right? So when you play blackjack, right, you want obviously the best hand you possibly can. I'm not going to teach you how to play blackjack in this video by any means, but say you really need a 7. You really need a 7 for whatever reason. You need a 7 to come up. That's luck. Like, you're basically flipping a coin. It's just luck if you get a 7 or not. As opposed to investing, it's work. It's work. You have to decide, you put in the work. This, it's just whatever card you get, you get. If you're gambling, whatever you get, you got to deal with it. Investing, it's up to you to take advantage and take control. Can you tell me how trying and hoping you get a 7 card is the same thing to reading a 10K, reading a 10Q, researching your strategy, listening to the conference calls, doing all of these different things in order to make sure that's the best place for your money? That's work, guys. That is not gambling by all. Now, can the stock market be gambling? Yes, it can. If you want to be a gambler in the stock market, you can definitely be a gambler in the stock market. YOLO buying, that is gambling. So what do I mean by YOLO buying? Say you watch CNBC, you see Cramer talking about a stock he likes for whatever reason he's talking about. He like, oh, this could really go up over a matter of time, and you don't do any research work. You just simply put your money in that stock, and then that is gambling, okay? If you're not doing the research work, if you're not developing your own opinions about your strategies, the companies you're investing in, that is gambling. And I mean, if you're okay with that, that's completely fine. But if you want to put in the work and you want to invest as opposed to gambling, you got to read the 10Ks, you got to read the 10Qs, you got to make sure you understand your strategy, you've got to have a plan. The market dips 20%, what are you going to do? The market goes up 20%, what are you going to do? You got to have a plan, you got to think through these things, and if you're doing that, you're investing. You're not gambling, you're not waiting for that 7 to come up, right? You're not hoping you get lucky. You're actually not even worried because you know your strategy, you know the company, you're confident in them, and you know they're going to make you money over the long term. The second myth about the stock market we're going to be talking about in this video is that the stock market is only for the rich. Now, this is something that there's so much wrong with this one. So rich people invest in the stock market, right? Most of the wealth in the stock market is from the rich. It's true. You can look it up. A lot of the people who are rich invest in the stock market. They're rich because of that. They're rich because they're buying assets. They're not letting that extra $5,000, $10,000, $50,000, $100,000, whatever money that's not in their emergency fund that they need, whatever they allocate that to be, sitting around, they don't just let it sit in the savings accounts. They're investing in assets so that can make them more money, guys. So it can make them more money. So keep in mind, not all of these people that invest in the stock market, not all these people consider rich, not all of them always had money. a lot of them, or not a lot of them, but some of them come from poverty. I know tons of people who are very, very wealthy. They come from poverty. They don't come from great backgrounds. They started investing in the stock market consistently, often, frequently, however you want to phrase it. And they'd be able to, slowly by slowly, they grew their wealth, and it just got to a point where it was a domino effect and it just took off. And you can do this too. You can do it by starting investing in the market. A lot of people don't. If you want to take that step, I think it's a good idea. Make sure you're doing your own research if that's something you want to do. Now, you might be saying, well, Josh, if everyone get rich by investing in the stock market, why doesn't everyone just do it? I don't know. Just kidding. But the fact of the matter is, a lot of people don't understand the stock market. Actually, only about 55% of people actually invest in the stock market. And I don't know how much of that 55% is actually, people investing based off strategies they know, researching individual companies. I feel like a good percentage of that is people just like either one, throwing money in the market, maybe it's made up of like 401ks and Roths and safes, things like that, that maybe some financial advisor, which I am not, by the way, some financial advisor does and creates for them. It could definitely be that. And I also don't know how much of that 55% is actually investing consistently, often, and really, like I just said, understands their strategies. And what I think a lot of people do, and something else that might be asked is like, well, if you are investing consistently and often, why aren't you building wealth? It's because I think a lot of people actually panic sell. So what do I mean by that? So say you see green, life's great. It's like nothing can go wrong. Everything's green. The market's up because stocks only go up. Right? But then I think a lot of people, like say back in March, you see them panic selling. So when the market takes a big dip, because stocks don't always go up, there's going to be corrections in the market, there's going to be dips in the market, you got to make sure you're ready for that. But I think a lot of people see that, they see that dip and they panic. They see their portfolio going down, they see them losing money even though they're not losing money. They end up selling off and taking losses and they end up losing money. When in all reality, if they had just held or even bought, they would have made so much more money over the long term. So if you're someone that is interested in investing, I would say put in the research work and start off with researching the markets, understand how the markets move, understand why they move, start off with the simple things, then move into investing strategies, whether that's index fund investing, value investing, or growth stock investing. I would recommend starting off just like with the research portion. That's going to be very important to build that base first. But once you do this, you can start investing in the market and you're already going to be ahead of the game because you already have things you believe in, you already have strategies you believe in, you already have methods you believe in, and it's just going to honestly be better for you over the long term. The third stock market myth we're going to be debunking is what goes up must come down and what goes down must come up. Now, sometimes in the short term, something might happen to the company and it really sells off and it really goes down. And it's something that really isn't going to affect the company over the long term. So it might be a good turnaround play, like what we like to call it. And it might be a good buying opportunity. It might be a good opportunity in general. A good example, it might be a company that was affected by this virus, right? Obviously, it's affected and it's going to have some short-term effects to the company. But as long as the fundamentals stay the same and as long as the management team continues to adapt and execute, over the long term, it could definitely come back, and most will come back over the course of so many years, and it could be a great turnaround play. Anyway, getting back to the point of number 3 here, we're going to start off with what goes up must come down. So obviously Amazon's over 3,000 right now. I'm not sure exactly what it's at, but people are thinking like, all right, I'll just wait for Amazon to dip. It's going to dip eventually. It's going to dip. How far do you expect it to dip exactly? It's Amazon, first of all, but do you really see Amazon going down 15%? Like, for example, say 2018, Amazon dipped to about $1,300 at the end of 2018 when there was that really big sell-off in the market. Do you really think Amazon's going to drop 50+%? Like ever again? I mean, I guess possibly because anything can happen, but do you really believe Amazon's gonna drop 50%? If you do, I mean, more power to you. I hope you are way smarter than me because that is a very bold statement. But that's the point. Just because the stock keeps going up does not mean it's always gonna come back down. Great assets are gonna continue to go up really forever, okay? Like literally forever. And stocks could pull back. Like eventually Amazon probably will pull back at one point or another, but I don't know if it's gonna go down all the way to 1,300. Like if you're thinking it's gonna go down 50+%, I don't know if it's gonna go down that far. And a lot of the times what happens, if you're in this situation and you're like, let me just wait, it's gonna go down, it's gonna pull back, it's gonna go back. It's like sometimes Amazon will go from 3,000 to 2,500, and you're like, it's gonna keep going down. Then it's gonna go from 25,000 to 2,000, like, it's gonna keep going down. But a lot of the time, it doesn't keep going down. It just has that slight pullback and then just goes right back up eventually over the long term. So if great assets are going to make you money over the long term regardless, so make sure you're getting in them at fair prices and not just waiting for it to go down, 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 because you might just be wasting time, and wasting time you could be making money. As for what goes down must come up, so sometimes stock do go down in the short term. Sometimes I like to buy turnaround plays. Maybe they went down for something that happened in the short term. Over the long term, I believe that company's gonna recover and they're gonna execute on their numbers and their business is gonna pick back up. So it might be a good investment opportunity. But what if something goes wrong with that company that's a long-term problem? What if the CEO leaves, right? What if the CEO leaves and the CEO that comes in is not someone you believe is the best person for the job? What if there's a big scandal that comes out about the company like you're seeing with Nikola right now? What if something like that happens? Is that company going to be able to recover over the long term? Or is that going to really affect the company and their business and really all their revenues and all those type of things? What if the company ends up going bankrupt? Is that company really going to come back? All these things you got to take into consideration. And it just comes back to understanding the company, understanding your strategy, and investing, not gambling, investing. Okay guys, so the fourth myth that we are going to be talking about, that we're going to be debunking in this video, is that you need a lot of money to invest, and you can't invest unless you have a lot of money. Now this is wrong for so many different reasons I can't even begin to tell you about. Actually, that's a lie, because I am going to start to tell you about it. So I would say, keep in mind, do your own research. I'm not a financial advisor, but I would say you need to be investing as much as you can comfortably, okay? Now when I say comfortably, I don't mean, okay, let me put every single penny I have in the stock market. Don't do that, okay? Because then, like, what happens if the market dips? What happens if you lose your job? What happens if you need some money? Always have some cash lying around. Always have some money lying around. I usually try to keep between 10 and 30% of my wealth around in cash. That's what I've learned from everything I've researched. That's a really good rule of thumb. Always make sure you have some cash around, because you never know. That's the bottom line. 2020 should have been an indicator, and yes, we can say should have, not is, but should have, because we're in 2021 now. It should have been an indicator that you never know what's gonna happen. Anything can happen, and you always need some cash lying around. Always, whether it's to pay bills, take advantage of other investment opportunities, whatever that case may be, have some around. But the bottom line is, investing money is not a luxury. It's not something that, oh, only the smart do. It's a necessity. If you ever want to retire, if you ever want to live your dreams, investing is honestly a necessity. It's something you have to do, and it's much, much better if you start doing it younger as opposed to in your 50s or 60s. Granted, it might not be a bad time to do it then either, but you have to do it, guys. It's absolutely a necessity. And you don't need a lot of money to do it, because you can buy fractional shares, first of all. And if you don't know what fractional shares are, say you want to buy a stock that's $100, but you only have $50 to put into it. You can buy half that share. And you can do it, say you only had $25, you can buy a quarter of that share, and so on, guys. So I think you get my point on that. That's something I would recommend doing, and it's going to be good for a lot of reasons, because you'll be able to dabble your feet into the market a little bit, and you'll just get used to it. But I would actually recommend, if you're first getting into the market, to start investing with little or no money. And why do I think this? Because, well, first of all, you're going to be able to develop your risk tolerance at the end of the day. Now, what do I mean when I say risk tolerance? I've talked about this in videos before, but I mean, like, say you're not gonna get like panic sell, do anything wrong when you see your portfolio go up 5% one day and down 5% the next day. It's not gonna affect you psychologically. You're gonna get used to seeing, that $10 or $20 move, and you're gonna be like, oh my God, I made, $20 today. You're gonna be like, oh my God, I lost $10 today. Maybe today's a good day to buy. You're gonna get used to the market, you're gonna get used to how to adapt to it. I would really recommend starting with little money at first so you don't do anything stupid, okay? Secondly, you're gonna get into the habit of it. Now, guys, you guys know the power of habit is one of the most powerful things in the world. If you get into the habit early on in your life of investing consistently and often, whether it's $10 a check, $20 a check, just little money like that every single week, taking out every single paycheck, paying yourself first, investing that money, treating it like a tax on your paycheck, guys, once you start making more money, like say you're making like $25,000 a year now, and you're investing consistently and often, what happens when you start making $50,000 a year, or $75,000 a year, or $100,000 a year? Then you pick a side job on the side, and you start making more money on top of that. It's just gonna continue to compound and compound over time. You already got the habit built. It doesn't matter. The habit's built, and you can just continue to do it. You continue to invest, continue to make more money. And if you keep your living expenses similar and you live below your means, you're just gonna have more money to invest. It's just gonna continue to compound. You're just gonna be able to make more and more money, getting yourself closer to financial freedom, closer to retirement, close to all these things that everyone wants, the true American dream, you're gonna be able to do because you already have the habit built. And it's just gonna be a domino effect once you get a certain amount in that portfolio, guys. Trust me, it's a great feeling to see that. When you wake up and you know you've already put in the work and you just see that portfolio skyrocketing, fantastic feeling. Now, if you're someone watching this video and you're like, I really don't have any money to invest, maybe you have a lot of debt you gotta get out of, maybe you have this expense, that expense, you try to cut as much as you can, but you really just don't have any money to invest, you barely have enough money to get by, I would recommend starting to research, okay? Research strategies, research the stock market, research stocks, okay? You don't have to put any money in. And I would actually recommend paper trading, okay? I think that would be a good idea for a lot of people. And what paper trading is it's basically a made up portfolio. You're investing with fake money. So say you have, I don't know, $100 in your portfolio, you can put $20 into this stock, $30 in this stock, but it's not actually real money. It's just like made up money, for lack of a better term. And that'll get used to you running a portfolio, seeing what you're doing good, seeing what you're doing bad. And then once you continue to research and you continue to do all this work, once you do get a little more money, it's game over, guys, because you already got the strategies. You already got the whole thing built. You have all the knowledge you need. Your human capital is skyrocketing. You continue to learn. It's just going to make you more and more money over time, guys. More and more money over time. But don't sleep on this, okay? If you don't have any money to invest, research, okay? Put an hour in a week, 2 hours in a week, an hour in a day, whatever you can afford to put in. Any free time you have, just put into researching. I did that for the longest time. I would be working at the cafeteria. I'd be working at URI. I'd be working there, and I would spend my lunch breaks reading books. I would spend my lunch breaks researching stocks, guys. I put in this work for a few years now, many years now. It didn't come overnight, and I'm so happy I did, because that's honestly the best investment for my time, was researching and learning, because it's going to pay off for me so much in the long run, and it can do the exact same for you if you're willing to put in the work. And the last and final myth we're going to be talking about on this list is you can't I'm actually on the wrong side, is you can't outperform the market. So for beginners, guys, maybe it'll be tough to outperform the market because you don't know what to look for, you don't know exactly what you're doing. So maybe for someone that's not willing to put in the work, it's going to be very hard to outperform the market. But if you're willing to read the 10Ks, read the 10Qs, listen to conference calls, do all these different things, what is the reason you can't outperform the market? You're only going to get better at reading, you're only going to get better at research, you're only going to get better at understanding companies. There's no reason you can't outperform the market if you're not willing to put in the work. I can tell you that being in Jeremy's private group, I see tons and tons of people outperforming the market. Almost everyone in there outperforms the market. I outperformed the market this year. Almost everyone outperforms the market, guys. I don't think it's easy to outperform the market, but if you're willing to put in the work, I don't think it's hard by any means. No, not at all. You can definitely outperform the market if you're willing to learn, research, and put in the work. And that's what this all comes back to, guys. Putting in the work. If you put in the work, you can absolutely outperform the market. Absolutely. There's no ifs, ands, or buts about it. You can do it. I believe in you. I really think you can do it. You just have to start, guys. That's one of the most powerful things you can do in this world, is starting to learn something, starting to research something, taking risks, taking on a new business venture. All you got to do is just start, guys. It really comes down to that. I really hope you guys got some value out of this video. I really hope you guys learned a lot. If you hear any of these myths said to you, then make sure, I would recommend going and researching a little bit and doing some of your own research, because I had all these said to me when I was younger. I believed them all the way up, really up until, I don't know, the last 5 years or so. I really believed them. And then when I started researching, I realized that I was given false information. And honestly, if I had have done that research work a little bit earlier in my life, I would have been making a lot more money than I'm making now. So anyway, guys, like I just said, hope you guys enjoyed this video. Hope you got some value out of it. If you did, make sure to drop a like on the video. That would really help out the channel in a massive way. Also, remember to subscribe to the channel as well if you want to see more videos like this. Let me know down in the comments what your favorite stock market myth is, and I'll see you guys in the next video.